Great. Good morning once again, and I would want us to start right away with our revision, and I would want us straight away to look at the concept of audit risk. Audit risk, the risk that you as an auditor will give a wrong opinion, inappropriate audit opinion. That if the audit opinion that was supposed to be given here was unqualified, you went ahead and gave what here a qualified opinion because of what here perhaps your evidence collection procedures were faulty, etc, etc. So I would want us, ladies and gentlemen, to look at this question. Mason Air Services is a company that provides specialist helicopter support to the emergency services and the Coast Guard. Two owner managers, directors, set up the company 9 years ago. Set up the company 9 years ago. It will be always important for you to start by reading what are the requirements. The requirement will be able to guide us very well. Using the information provided, describe 5 audit risks and explain the auditor's response to each risk in planning the audit of Mason Air Services. 10 marks. So describe 5 audit risks and explain the auditor's response to each risk in planning the audit of Mason Air Services, MAS. So now we can go back and continue reading here. Mason Air Services is a company that provides specialist helicopter support to the emergency services and the Coast Guard. 2 owner managers set up the company 9 years ago. You are the audit senior and you are planning the audit for the year ended 31st December 2010. Following a recent visit to the client, you have ascertained the following information. The company maintains a helicopter fleet comprising a range of aircraft types and carrying specialist equipment. The company also trains and provides specialist pilots. Under the terms of a 5-year contract, they charge an annual fee to their customers to cover the maintenance, storage, and the testing of the aircraft and equipment. The annual fee is payable in advance each year, with the first annual payment being paid on the date the contract commences. Customers are then also charged an additional fee per flying hour based on the usage of an aircraft. This charge per flying hour is also set out in the contract. However, when preparing sales invoices, rather than going back to the contract, the financial controller said they use the last invoice to pick up the hourly charge. You can see a risk there, you can see a problem there. Their customers comprise solely of the police, the ambulance service, the fire service, and the Coast Guard. The contracts in place are all of a similar value and are considered by management to be very profitable. The company has always made a healthy profit before interest and tax. However, Mason Air Service owns the helicopters and funded the original purchase of each aircraft with a secured loan carrying substantial interest charges. As a result, the anticipated draft profits for 2010 after inherent interest and tax are relatively modest at around 500,000 for the year when compared with the expected revenue of 45 million. So they anticipate to make 500,000, and of course you can see the revenue that they're expecting is 45. So this is profit, this is revenue. The contract with the police force expires in March 2021, for example. Remember, they only have those guys. These guys are their major clients. And the police are trying to substantially reduce the amount they pay annually and per flying hour in the wake of government cuts. It is thought that the contract will be put out to tender and another aircraft provider may also bid for the contract. So there's a big risk of them losing this work. A new contract for the provision of air ambulances was signed during the year with increased flying hour charges. Although no new helicopters have been purchased during the year to 31st December 2020, there has been a lot of refitting, replacement, and adding of specialist equipment to some of the aircraft. This has been necessary to keep up with the latest development in search and rescue and to maintain the aircraft to the high standard required under the contract in place. The company maintains around 2 million of aircraft spares, which are included within inventory. Inventory is a risk area. Approximately a quarter of this value is made up of specialist equipment taken out of aircraft where it was replaced by newer or more advanced equipment. The directors have estimated the value of this equipment and have included it within inventory, as they say it still works as well as it did when it was installed. Required, using the information provided, describe 5 audit risks and explain the auditor's response to each risk in planning the audit of Mason Air Services. So I would want to give you exactly 5 minutes, and I would want to see you guys giving it your best shot, trying to write whatever type of risk that comes to your mind, and then we shall be able to assess these things together. Let me see whether, before I project again, whether you've got new people who have just come in. There are only 5, quite a small number, but we shall overcome. We shall overcome. We shall overcome. So this is the question. This is the question. This is the question. Yes. So your work this morning is to identify what year. Your work this morning is to identify the various types of not just risks, but audit risks. What may make you give a wrong audit opinion in these scenarios? Okay. Okay. So, ladies and gentlemen, what is your take on this type of a question? What do you think of this type of a question if it was to come on Thursday this week? Is it an easy question or a very tough question? Is it a very easy question or a very tough question? Please respond to me through the chats. Respond to me through the chats. Is it easy or tough? Is it easy or tough? I'm waiting to hear from you. Please talk to me. Please talk to me. This kind of a question, is it easy or very tough? I'm trying to test also whether you are able to hear me kindly. Is it an easy question or a tough question? Vic says it's doable. Thank you very much. It's doable. What about the other students? What about the other students? What about the other students? Please be very honest. Tell me in this case here what your take is. Doable. Great. Now, ladies and gentlemen, the most important thing is for you to be able to identify the major risks. The risks that I'm able to see here, number one, myself, I'm able to see the risk of what here, over-reliance over very few customers. A company in this case that over-relies on very few customers, like now you can see we have the police here, the police, even their contract are coming to an end, right? And there is a possibility that these guys would want us even to reduce what you're charging them because there is pressure from government cuts, right? So there is a big risk here that even this company is going concern may be at stake, right? Ladies and gentlemen, look at how they are valuing their inventory. There is quite a big risk there, but they are getting some spare parts from the aircrafts, right? They've replaced some of the spare parts from their aircrafts. And then they are going right away to take these replaced, the assets, or rather the parts they move from this aircraft to their inventory. And the argument is that these spare parts can be reused in the future, that they're still in good condition. Remember, IAS 2 tells us that whenever we want to value inventory properly, we have to look at what here, two things. We must compare cost vis-a-vis what here net realizable value. That this part cost us maybe 2,000 Kenya shillings, assuming 2,000 Kenya shillings. But if I want to sell it today, how much will I be able to fetch less cost of selling? Remember that these are specialist parts. These are specialist parts. Specialist parts are parts that you can't easily get a buyer, right? So I see a big problem there in terms of what here inventory valuation. And as an auditor, I need to be quite cognizant of this risky area. If I'm not, in this case here, careful, if I don't handle the inventory concept very well there, I'm going for sure to give a wrong audit what here opinion. To give a wrong audit opinion. Ladies and gentlemen, there is another big risk that I'm able to see. I'm going to project this answer to you. There's another big risk that I'm able to see here. You know, they've told us that they normally do revenue recognition up front in advance, regardless of the date that we have issued a contract like this, and then we take the entire revenue and automatically lump it to our income statement. There is no problem with that, so long as you really understand the concept of cut-off procedure. Now, assuming these contracts here were issued on the 1st of January, 2020, all of them, then that entire revenue for sure should belong to which month, should belong to which year, should belong to 2020. But what if a contract is issued on March or on April? You see, part of this revenue we want to recognize fully in the year 2020 is supposed to go to 2021, right? So there is a risk there of mismatch. There is a risk there of mismatch. I'll be able to describe that even better. But for now, I want you to understand the concept of what here, high level, high level, high level, high level, high level. Great. So allow me to project the answer to you so you can go through the answer, all of us. So this is question number 31. So question number 31, I'll share with you this book immediately after this class. And I want to believe it will really be of big help to you guys. Big help. Big help. Great. Now it is here. So they're giving us audit risk and a response to risk. I'll read very slowly. We are told the company charges an annual fee which is payable in advance based on the contract date. There is a risk that the revenue for the annual fees is not properly recognized in the period to which it relates, leading to revenue and deferred income being misstated in the financial statements. Then as an auditor, what will I do? I must obtain copies of all contracts and I use the terms to calculate the annual charge for each. Then compare these with the revenue recorded for annual charges in the financial statements. Investigate any discrepancies. And remember the way I explained this. We're told up there that these guys were recognizing revenue in advance. These questions are very common. When you're told that revenue is being recognized in advance, once we issue a contract like this, we take the amount which have been promised by our customers and recognize fully, automatically there'll be a problem with cut-off procedure. There is some revenue of contracts that are issued in between the year, which will be overflowing to the next year. So as an auditor, I must get copies of all contracts and use the terms to calculate the annual charge myself and get to see how they have done the classification, how they have done, in this case here, the allocations of these particular revenues to the respective years. Now go to the second risk. The flying hour charge per hour used on the invoice is not, they said somewhere up there, if you remember, that whenever they want, in this case here, to calculate the flying cost per hour, they look at the last invoice. That is wrong. That is wrong. It is always important, ladies and gentlemen, that you make reference, when you are billing, make reference to the original contracts, because things keep on changing, right? So the flying hour charge per hour used on the invoice is not based on the relevant contract, but instead on the last invoice. As a contract has been renewed in the year for the ambulance service, the historic charge may have been incorrectly included on the invoices, and therefore revenue recorded may not reflect the value of the services provided. There is also a risk of errors in one invoice being repeated in subsequent invoices. Ladies and gentlemen, please, when you are doing your billings, even at your workplaces, you don't look at like how much did I charge this guy last month. I mean, we always must go back to the original OTR contract, always. Inspect both the old and the new air ambulance contracts to establish when the new hourly rate should have been charged. For a sample of invoices after that date, ensure the new rate was applied and recorded. Review a sample of invoices during the year or other contracts to ensure the rate charged is as per the contract. In case contract revisions in previous years have been missed. We got the third risk, which is something which may make you to give a wrong opinion. We are told here that Mason Air Services has only 4 customers, and each makes up a significant proportion of revenue, as contracts are of a similar value. Given profits are 500 and 1/4 of revenue is 11 million, the loss of just one customer will make Mason loss making and may threaten the company's ability to continue as a going concern. Forget about even the things I'm mentioning here. The thing is, when you have, ladies and gentlemen, very few customers, there is a risk of you getting a bankrupt. Should those customers in this case here think otherwise and go to another what here, another seller, another company. So then what are you supposed to do yourself as an auditor? Each contract should be reviewed for break clauses and end date to assess the risk that contracts may not continue for the foreseeable future. Board minutes and correspondence should be reviewed for evidence of customer dissatisfaction or evidence the contracts will not be renewed. Like, remember, up there we were told that the police in this case here are likely to do what here, to look for this service elsewhere. So the key thing, ladies and gentlemen, to be able to assess going concern, normally ask for correspondences between the company and their clients, right? For you to be able to see really whether there is or rather what level of dissatisfaction do these clients here have against what here the company. When you see dissatisfaction going up, too many complaints, then automatically you know that there is a risk that these guys may pull out, right? Now, audit risk, the contract the police force runs out in March 2021, and the police are trying to substantially reduce the contract charge. The reduction of the contract charge or the loss of the contract to a competitor could threaten the going concern of the company. Therefore, risk that the basis of or disclosure in the financial statements is incorrect. Inquire of management as to the progress of the contract negotiations and inspect board minutes to correspondence for evidence of discussions on this matter. If figures are available for the proposed decrease in charges, estimate the impact on revenue and profits to assess the effect on going concern. Review any disclosures in relation to this matter for compliance with what here? With IFRS. There is a risk that the cost of refitting, replacement, and adding of specialist equipment to the aircraft has been incorrectly treated as revenue expenditure, which should have been a capital expenditure. Ladies and gentlemen, remember, whenever you are, for example, doing capital repairs, even if it's to a building, something that will be able to enhance the value in use of a building, then that expenditure should be capitalized and taken to the statement of financial position. So anytime these examiners talk of repair cost, there is always that risk that they have not assessed those repairs nicely to be able to tell whether repair costs should go to the balance sheet or should go to the income statement. Remember, if the repairs that you are doing are immaterial, if they are immaterial, we take them to the income statement, meaning that they are what here, they are revenue expenditure. If they are material and they're going to enhance, for example, the longevity of this aircraft, automatically we should be able to capitalize them and then take them to the balance sheet. So anytime they talk of, I like this because I'm able to remember what I was doing when I was a student as well, a student of CP and ACCA. Yeah, there are those common things that once I see, I'll be able to tell for sure that there is a risk there of what year of classification. How are they classifying these repairs, right? So I'm reading again. There is a risk that the cost of refitting, replacement, and adding of specialist equipment to the aircraft has been incorrectly treated as revenue expenditure when it should have been capital expenditure or vice versa. This would result in the non-current assets or repairs costs being misstated in the financial statements. So then what do I do as an auditor? What is the response to this risk? An analysis of this cost should be reviewed and traced to the invoices. The invoice descriptions and supporting documents should be reviewed to assess the nature of the expenditure. once established as either capital or revenue, it should be traced to the general ledger and the financial statements to ensure it has been classified correctly as an asset or what year repairs. Ladies and gentlemen, please remember as you're doing this, as you're doing this, oh, you're not able, are you able to see my screen? Sorry, are you able to see my screen? Oh, I don't know why the Galaxy student is not able to see my screen. Okay. So remember, as you're looking at audit risk, always remember the risks at assertion level. Risks at assertion level. Assertion, if you can remember our assertions we normally talk of what here? ACCA cover. ACCA cover, P with a P at the end. Right? So when, for example, somebody tells you that revenue is being recognized at the beginning, recognized in advance, always think of the cutoff, right? Is this revenue being cut off and placed in proper financial years, right? We have the concept of what year? Allocations, classification, right? Like now these repairs. Where are we taking these costs really, right? So it's very important for us always to think about this. Now look at the next one. Approximately $500,000 of equipment, including inventory, has been replaced, suggesting such equipment is no longer fit for purpose, even though it may be functional. In addition, the value of the replaced equipment has been estimated by the directors, and there is a risk that inventory is not recorded at the lower of cost and NRV. Inventory could therefore be materially overstated. Ladies and gentlemen, they're not even putting it in a proper language here. The thing is, you've gone and removed spares from these aircrafts. For sure, what that would mean is that these particular spare parts are not fit for use. Why should you take them back to the inventory? Right? If you're told today to sell these particular spare parts that you've removed from your aircrafts, do you think you'll be able to sell them really? No. And that is why IAS2 tells us always to value stocks at cost or net realizable value, whichever is lower. So in this case here, I know there is an inappropriate valuation cover that V. There is inappropriate valuation of what here? Inventory. It's a risky area. If I'm not so careful, here I'm going to give a wrong opinion. So this is something that I must always work on to ensure that they are valued properly for me to be able to give a proper audit of opinion. So an inquire of management where there is an alternative use or market for the equipment and the likely selling price in any alternative market. Establish the cost of the equipment by referring to previous year's files or to original purchase invoices. Compare the cost with the net realizable value and see if the lower of the two shows the director's estimate to be reasonable. If there is no alternative market, and the equipment is unlikely to be used going forward, discuss the need for a write-down with management. If the asset can continue to be used in the business, e.g. for training, consider whether it should be classified as a non-current asset rather than as aircraft spares within the inventory. So, ladies and gentlemen, I want to imagine that this has been helpful in some way. Have you been able to pick? Remember, it's a high level. You don't have to cram. You don't want to cram at all. It's a high level. Have you been able to pick something there that we can use in our exams? Have we been able to pick something there that we can easily use in our exams? Please try to talk to me. Try to talk to me kindly. Okay, great. Now, and you'll bear witness with me later on that normally some of these questions here of ACCA find their way to where they find their way to SNAP papers. You'll be able to bear witness. As the more the questions we do, the better, the better. Now, ladies and gentlemen, from there then come and go with me to the next question, which is Bings by. So question number 32. Question number 32, Bings by. So Bings by is here. So question number 32, Bings by. Always start by reading the requirement, always. List and explain the purpose of 3 of the main sections of an audit strategy document. And for each section, provide an example relevant to Bings by. Can somebody in this case, ladies and gentlemen, give me those? First of all, tell me what is an audit strategy document? What is audit strategy document? And then give me 3 sections, which will be there in the audit strategy document. Please, please, what's an audit strategy document? Remember when you are planning, after you have been able to understand the entities, the environment, right? You've understood the ICS, you've been able to measure risk materiality, right? You have to sit down and document those great things in what we call an audit strategy document. I'm waiting to hear whether there is anybody who will be able to really tell me what an audit strategy document is. I'm waiting to hear from you. I'm waiting to hear from you. Audit strategy document. Is it a concept that you guys have covered in your class? Have you covered this audit strategy document in your class, normal class? Do you cover this? Do you know that there's a difference between? So first of all, answer that question. Have you covered audit strategy document in your class? You simply say Y for yes or N for no. Y for yes or N for no. How about the other students? You guys are not really cooperating and it's early morning. I would want to hear you. If you never covered, just be bold, tell me no. If you covered it, say yes. Okay, now ladies and gentlemen, this is a simple area, no problem. This is a simple area, it's a very simple area. When we talk over an audit strategy document, this is basically that document that will give us the path. Where do we follow for us to be able to give the right opinion at the end of our audit? So it sets the direction, timing, and the scope of the audit, 3 things. An audit strategy sets the direction, timing, and the scope of an audit. At the end of the day, it will be used as a guideline. It will be used as a guideline when developing an audit plan. It will be used as a guideline when developing an audit plan. Right? So the key things I would want you to understand from the word go, it's quite an easy area, is that an audit strategy sets the direction, timing, and the scope of an audit. And it is the document that we shall be able to make reference to when we are building up our audit plan, and I'll be able to explain what an audit plan is. Right? So remember, ladies and gentlemen, when it comes to this audit strategy document paper, we have to put down the scope of the engagement in our own understanding as auditors, the characteristics of the engagement, the timing of the audit. Are we going to do an interim audit? Are we going to do, in this case here, for example, just a final audit? The timing of the audit is very important. Nature of communications, how shall we be communicating with the directors, for example? Right? Right? So then let us go very fast and read this up here. You are an audit senior working for Sam's company and are now commencing the planning of the annual audit of Bingsby Company, which owns and runs a chain of gastropubs in the southwest of England. The date is 4th December 2009, and the Bingsby year end is 31st December 2009. It will be very important for you to always understand the dates, right? Bingsby has proved to be very popular in recent years. This year, it saw its revenue from sales of food and drink increase by 15% compared to the previous year. In view of its success, the directors are considering plans to expand the business by acquiring other pubs in the region. 70% of Bingsby takings are paid in cash, very risky, with the remainder being paid by credit card. For the first time this year, Bingsby has outsourced its payroll function to a firm of accountants called Ricks and Company. Payroll costs form a substantial cost in Bingsby's statement of profit or loss, so it's material. So meaning as an auditor, I really have to check whether Ricks and Company are very competent. They're very competent. Their competence can't be in doubt if this particular item they're working on is material. Ricks and Company prepare the payroll records and update it for status and leavers based on information provided by Bingsby. A series of payroll reports are securely emailed to Bingsby each month and reviewed by the appropriate management. Payments are made to employees on the basis of a net pay report provided, and journals are put through to reflect the wages, cost, and related liabilities. So list and explain the purpose of 3 of the main sections of an audit strategy document, and for each section, provide an example relevant to Bingsby. I'll simply go to the answer because you've told me you have not done this. Great. Okay, so you can see here they're giving you the marking scheme, audit strategy document. For each section of audit strategy document, I have for explaining the purpose of that section, 1 for the relevant example from the scenario, the procedure, understanding the entity's environment, understanding the accounting and control systems, risk and materiality, timing and extent of audit procedures, coordination, supervision, and review of work. This is very important are the relevant points. Great. So we start with this. Audit strategy document section. Characteristic of the engagement. Purpose. Provides details of the industry and regulatory environment the client operates in. Describes the entity's activities. If today you are given to go and audit a bank, it will be very important for you to understand the banking industry. it will be very important for you to understand how regulators operate. Otherwise, you will get yourself into trouble as an auditor, right? So example relevant to Bingsby, Bingsby runs a chain of gastropubs. I'm trying to understand the company. As a result, it will need to comply with significant food hygiene and health and safety regulations. I like that. The other section of the audit strategy document is the reporting objectives, timing of the audit engagement, and nature of communications. Provides details of the client's reporting dates, the proposed timetable, because you have to do a timetable here, and dates for proposed meetings with management. The audit is being planned less than a month before the end of the period to be audited. It may be necessary to schedule an initial meeting with management before year end to ensure any necessary year-end testing can be carried out. Remember the year-end testing, those tests that you basically do, the tests that basically you do before the financial statements are released will be in most cases to do with what here? Internal controls. Internal controls, are they working? So e.g. and current asset verification, food and beverages, etc. So the concept is, under the audit strategy document, a high-level knowledge, we are looking at reporting objectives, timing of the audit engagement, and nature of communications. How do we communicate with management? And most importantly, we must have, in this case here, an entry meeting, right? Like on the 4th, once I check in, I would always want to request this management, before I even start, I'm going to get most of the information from you people, even to understand the industry, to understand the company's activities. I would want an entry meeting. For accountants, entry and exit meetings are very, very important, right? So we have significant factors, preliminary engagement activities, and the knowledge gained on other engagements. As an auditor, I don't want to get into a very new industry that I'm not so good at. I must document all the experiences, knowledge. Do I really have the capacity to do this audit? So identify areas where there is a greater risk of material misstatement and a greater susceptibility to fraud. Details management commitment to design, implementation, and the maintenance of sound internal control environment. Details the basis for setting materiality. This is not very clear, at times how they give the answers also. The most important thing, ladies and gentlemen, here is that I'm documenting knowledge gained on other engagements, on other similar engagements. So Bingsby makes cash sales. This increases the susceptibility to fraud. An approach which can appropriately test completeness of income is needed. Great. So remember, it's a high level. So long as you're able to appreciate this thing at a high level, that will be enough for you. Great. So we go back to part B of this question. Now, part B of this question is an interesting one. This one is something that each one of us can answer. They want us to describe the audit team's responsibilities in relation to obtaining an understanding of the services provided by RICS and the company when planning the audit of Bingsby. Describe the audit teams, the engagement teams' responsibilities in relation to obtaining an understanding of the services provided by RICS and the company. Remember, we outsourced the payroll to them. So could you kindly, you guys, talk to me this morning? What do you think will be the auditor's responsibilities in relation to this outsourced service in relation to the company that has been given the work? Now we have to break the ice. You must talk to me. Don't worry about the quality of the answers. You must talk to me. 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 You must talk to me kindly. You must talk to me. You must talk to me. There are things I cannot forget here. Vic, that's quite a nice one. But remember, here really, they want you to look at two things here. The relationship between Bings by the company and Rick. Right? So here, Vic, they want us to look at this company that has been given this job. We call them service providers, vis-a-vis the company giving out the job. The company giving out the job. What are you going to look at? What are you going to look at for you to be really satisfied whether there is effectiveness in terms of what here service delivery? Of course, this is found under ISA 402. ISA 402, ISA 402, ISA 402, ISA 402, right? Where in this case here, they tell us the biggest thing that I'll never forget about ISA 402 is the communication aspect between Ricks and what here Bings by. How often do they communicate? I would want that file. I would want the file of correspondences between these two companies. So that degree of interaction to me is so important. Now, ladies and gentlemen, the other thing that ISA 402 talks about quite seriously is the nature of the outsourced work. The nature of the outsourced work. Is this company trying to give out a core business? If you give out core business, then that is a very big risk for the company. So I have to understand the nature. I have to understand the nature of the concept that is being given out there, ladies and gentlemen. Then we have materiality. Is this something quite small that I can do away without? Right? So materiality is key. Materiality is key. And then now you can go to the concept of now the contract which is in existence, the qualifications and experience of this company, etc, 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 etc. If it's internal auditor, independence, right? So those are the kind of things you look at whenever you're told to analyze the concept of what your service organizations. When you're being given service from out there, is this thing material? If it's material as an auditor, I'll really put my nose in it, right? These particular two companies, are they talking to each other? Bings by and Ricks, are they talking to each other? I would be interested in the correspondence file. I would be interested in any contracts drawn between the two companies. I would be interested in the nature of the outsourced work. If it's secondary work, then I'll not have an issue. But if it's a primary job, then I must have every reason to really advise my clients through some management OTR letter. Now, auditors are required to plan and perform an audit with professional skepticism, to exercise professional judgment, and to comply with ethical standards. Explain what is meant by professional skepticism and why it is so important that the auditor maintains professional skepticism throughout the audit. Could you kindly help me now in this? So remember, professional skepticism, ladies and gentlemen, is an attitude which is expected of an auditor. An auditor is supposed to doubt every evidence given to him. So when you're given this audit, always try to see these people as people who are out there to con the company. They're bad people. So have a questioning mind. Have a questioning mind. And the importance of you maintaining, of course, this professional skepticism, it will help you to be able to dig out sufficient and appropriate audit evidence, which will be able to enable you give the right audit opinion. Right? So define professional judgment and describe 2 areas where professional judgment is applied when planning an audit of financial year statement. So when we talk of professional judgment, this is quite different from professional skepticism. So here you are a judge. A judge when things are uncertain, when things are not very clear, at times will be required, will be called upon as an auditor to use your own discretion. Given the experience you have, skills you have, use your own discretion to be able to ascertain, to be able to make some decisions, right? So basically, professional judgment is the application of what here relevant training, knowledge and experience in making informed decisions. And of course, we will be called upon to make professional judgments whenever things are not very clear. Whenever things are not very clear. So for instance, ladies and gentlemen, this concept of materiality, I mean, we can't have materiality which cuts across all organizations. No, it's me to come and look at this kind of organization that I've been given, right? If they have given me quite a complex organization, I'll be able to say this one, let the materiality be 2%. This one, let materiality be what here be 5%. So I'll be able to arrive at a professional judgment, right? Right? Depending on my skills. Especially, you know, when you're planning here, you're looking at things like what here, materiality. Yeah, materiality, basically it will be upon me. It will be upon me to set materiality levels depending on what I feel is adequate. Even during planning, ladies and gentlemen, the concept of the timing of my audit procedures, the concept of the timing of my audit procedures is purely at my discretion, right? It's purely at my discretion to decide that. Discuss the importance of assessing risks at the planning stage of an audit. I mean, how do you even get to know the kind of audit strategy, the kind of audit plan you're going to use if you don't know the risks? Discuss the importance of assessing risks at the planning stage. Take a minute and think through. Where should we assess risks? Ladies and gentlemen, remember, as an auditor, I'm not coming to do 100% of things in this organization. I'm not coming to carry out a census. If I do that, then everything here will become very complicated, will become even very expensive for my clients. So it's all about sampling. So when I'm assessing risks, I'll be able to identify those risk areas that I should be able to concentrate on. So it helps us identify areas of focus from the word go. When I'm trying to assess risk, ladies and gentlemen, the other point is that it will enable me to gain deeper understanding of the entity. Remember, we are called upon as auditors to ensure that we gain a lot of, we understand the company we are auditing deeply. Otherwise, there will be a mismatch in terms of audit opinion. Ladies and gentlemen, remember these particular risks you are assessing will form the basis for preparing our audit strategy document and audit plan. Lastly, when of course in this case here we are able to assess our risks, we'll be able to know who to place where. So it helps us in terms of what year allocation of employees to the various tasks in the audit process. So perhaps you could look at this question number 33, answer for you to be able to understand it at a high level, what is expected of you. Great. So you can start with importance of assessing risks at the planning stage. It's a 315 stage that the auditor shall identify and assess the risks of material misstatement at the financial statement level and at the assertion level for classes of transactions, account balances, and disclosures. It's very important that auditors carry out this risk assessment at the planning stage because it helps the auditor gain an understanding of the entity for audit purposes. It helps the auditor focus on the most important areas of the financial statements where material misstatements are more likely, therefore increasing audit efficiency. The risk assessment will form the basis of the audit strategy and a more detailed audit plan. Lastly, once the risks have been assessed, audit team members of sufficient skill and experience can be allocated to maximize the chance of those risks being what year addressed. Right. So ladies and gentlemen, can I go to something different? 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 They're not talking to me. They're not talking to me. Remember, it's helicopter. It's helicopter. It's helicopter. It's helicopter. Rosaline says yes. Why for yes? It's helicopter. This is something that I've really assisted so many students of audit with, this helicopter concept. Right? Now, before I leave this concept of risks and go to how do we set materiality levels, I would want us to do this question number 34. Sleep tight. So sleep tight, we are repeating the same concept. Using the information provided, describe 5 audit risks and explain the auditor's response to each risk in planning the audit of sleep company. 10 marks. 10 marks. 10 marks. So they're telling us here, we'll read it slowly. You are an audit senior for Mills and Company and are in the process of planning the audit of Sleep Tight Company, which has been an audit of Mills and Company for several years. Sleep Tight's principal activity is the manufacture and sale of expensive high-quality beds. Each bed is crafted by hand in the company's workshop and personalized in accordance with each customer's specific requirements. The shares in Sleep Tight are owned by 2 major directors who are sisters, Anna and Sophie Jones. Both have a number of other business interests. As a result, they only spend a few days a week working at the company and rely on the small accounts department to keep the finances in order and to keep them informed. There is no finance director, but the financial controller is a qualified accountant. Sleep Tight requires customers who place an order to pay a deposit of 40% of the total order value at the time the order is placed. The bed will take 4 to 8 weeks to build, and the remaining 60% of the order value is due within a week of the final delivery. Risks and rewards of ownership of the beds do not pass to the customer until the beds are delivered and signed for. Beds also come with a 2-year guarantee, and the financial controller has made a provision in respect of the expected costs to be incurred in relation to the beds still under guarantee. That's quite a risky area, guarantee, and I always have to talk about it. The company takes a full count of raw materials at the year end. Good. The quantities are recorded on inventory sheets, and the financial controller assigns the cost based on the cost assigned in the previous year. Or if there was no cost last year, using the latest invoice. Most beds are made of oak or other durable woods, and the cost of these raw materials is known to fluctuate considerably. So they're not mentioning anything to do with net realizable value. It is expected that the work in progress will be insignificant this year, but there will be a material amount of finished goods awaiting dispatch. Anna Jones will estimate the value of these finished goods, and has said she will take into account the order value when doing so. Required, using the information provided, describe 5 audit risks. So I want to give you 2 minutes to think through this question. Okay, so ladies and gentlemen, what kind of risks have you been able to identify that have issues? I can see so many risks here. Risks to do, for example, with valuation. Valuation of what here? Valuation of our stocks. First of all, stocks of raw materials. They have told us the quantities are recorded on inventory sheets and the financial controller assigns the cost based on the cost assigned in the previous year. No. How we should value this, it should be on actual cost basis, actual cost, right? Not the concept of latest invoice, right? The beds are made of oak or other durable woods, and the cost of this raw material is known to fluctuate. No problem. If the cost of the material fluctuates considerably, then what you need to do is to assign an average cost to them, right? And then we have also a problem with valuation of what here? The beds, the final goods. We are told Anna Jones will estimate the value of these finished goods, and as said, she will take into account the order value when doing so, which will be very wrong. Ladies and gentlemen, remember when you are valuing this bed, first of all, you have to value and tell us what is the cost of making this bed. When it is still in inventory, you can't value. You know, when you are talking of valuing your stock items at order value, this is like valuing it's like you're anticipating revenue, and there is it's not a must for you to sell. When it comes to valuation, of stocks, it doesn't matter how good they are. We must use what we call IAS2. IAS2, Anna Jones should be able to value these beds at the lower of cost stroke net realizable value. At the lower of cost stroke net realizable value, right? That's value to sell minus any cost of selling. So the lower, so if the cost we incur to make the bed is 1,000, and then the order value or the net realizable value is 1,500, the value we shall maintain these beds at in our books should be the cost of 1,000, the lower of cost. So I'm able to see that quite well there. Then we also have a risk of what here? This 40%, which is being recognized upfront, right? There's no problem with that. Actually, you should be able to recognize 100%, even without you being given the money. But you see, I'm concerned with the misstatement. I'm concerned with some of these monies here will be coming towards the end of the year, right? 40%, 60%, right? So there is the concept, ladies and gentlemen, of what here? Improper classification. Then there is these provisions being given here for guarantees. There is quite a big issue because of what here? That provision will be misstated. So I'll need to do quite a lot as an auditor to ensure that that provision is being carried out in the proper amounts. We are told here that the shares of this particular company are owned by two sisters. Two sisters would not have time for the company. That's a big risk. And even the accounting department that they have, they are calling it small accounts department. And you see, this is the department basically which will be putting up internal control systems. They even don't have a finance director. Remember, for internal controls to be effective at director level, at board level, we need a finance director. That's a risk. So if we go to this particular question and read the answer very fast, it's here. So the audit risk, the directors only work part-time at sleep tight, and there is no finance director. This may promote a weak control environment, resulting in undetected errors or frauds. So you're told here the controls will need to be documented and evaluated. If these are weak, the level of substantive testing will need to be increased accordingly. The requirement for customers to pay 40% on ordering and the remainder following delivery could result in revenue recorded before it should be. If the deposit is recorded as a sale, are not deferred until delivery. This would result in revenue being overstated. I told you from the word go, when you are told, ladies and gentlemen, that revenue is being, some revenue is being recognized upfront, there will always be that mismatch. There will always be that misstatement that I should suspect. Alternatively, revenue could be understated if the final payment were only recognized when it is received. I don't want to go into really depth of this. Most importantly is for us to appreciate that whenever you're told revenue is being recognized, even if it's 40, even if it's 100% upfront, there's always that mismatch. So auditor's response, inquire of management the point at which revenue is actually recognized and review the system of accounting for deposits to ensure that they are not included in revenue until goods delivered and signed for. For a sample of transactions within 8 weeks of the year end, ensure the revenue recorded is only in respect of the beds delivered to customers in the same period and ensure that they have been signed for. The 2-year guarantee on the beds gives rise to a provision, the measurement of which involves a high degree judgment and therefore carries a risk of misstatement. This risk is increased. No, the most important thing is just here that the provisions involves what here, high degree of judgment, and there's a risk of what here, misstatement. So of course, from management, I'll establish the basis of the amount provided for and assumptions made by the financial controller. I'll have to perform any calculations and establish the level of warranty cost in the year and compare with the previous provisions. Review the level of repair cost incurred post-year end and use this to assess reasonableness of the provision. The current year raw material costs for materials also in inventory last year are based on prices at last year's, at least a year old. They should be based on the actual cost or reasonable average cost. Given the prices fluctuate, the value of year-end raw materials may be over or undervalued. For a sample of materials to include the cost of good, compare material cost to actual prices on invoices, investigate and resolve any significant differences, and evaluate the potential impact on the inventory value in the financial statements. The finished goods value is to be estimated by Anna Jones, who appears to be basing her estimate on order value rather than applying IS2 rule that goods should be valued lower of cost and net realizable value. This could result in inventory being overstated in the financial statements. For beds awaiting dispatch, establish the lower of cost and net realizable value and compare with the figures provided by Anna Jones. Investigate any differences, evaluate the potential impact, etc. The new workshop is undergoing refurbishment that could result in appropriate treatment of capital or non-capital items. When you hear of this thing of repairs, refurbishment, always remember the classification may have an issue, right? The classification may have an issue. So, ladies and gentlemen, that is the last question that I was looking at. What year of audit risks, and we are well beyond our 1 hour. So please, I'll be able to pick it up from there tomorrow morning. So tomorrow morning at what time?